The mortgage market in the U.S. is definitely one of the most regulated markets that we have. Big banks, big financial institutions are always in favor of less regulations. We'll still continue to see financial institutions following those regulations for now, but over time, as sort of the regulatory environment changes, I think we'll see financial institutions adapt to the new paradigm. In general, deregulation, good or bad, it really just depends which side of the aisle you sit on.
Hi everyone, Serena Diaco here, and welcome back to the Digest. This week we have a very interesting topic regarding the CFPB shutdown. We have Jared Neale, an associate from the Imperial Fund, joining us here today to give us some advice and insights on the year to come. Thank you for tuning in and see you there. Hi Jared, thank you so much for being here today.
My pleasure, Serena. Thank you very much for having me.
I truly appreciate it, and we're so excited to hear all your insights on this matter.
Absolutely.
As you know, we'll be talking about the CFPB closure and any impact it might have, well, most definitely will have on the mortgage industry, and we'll jump right into it. Over the years, how has regulation affected the mortgage industry, whether it is the CFPB or other agencies?
The mortgage market in the U.S. is definitely one of the most regulated markets that we have, right? Coming out of the 2008 Great Financial Crisis, we had that very important piece of legislation, Dodd-Frank, which actually formed the CFPB as we know it today. Some significant legislation has been passed by the CFPB on behalf of the United States consumer. Things that regulating the overdraft fees that banks can charge, but anything from things as simple as, you have a dispute on your credit card and your bank is not agreeing with you. You say that it's fraud, the bank is saying that it's not fraud, and you need someone to represent you on your behalf to the banks, right? The Consumer Financial Protection Bureau is able to represent you to those banks and help you resolve whatever issue you might have, sort of act as an advocate on behalf of the consumer. The CFPB has pushed Congress to really act in favor of the U.S. consumer and have enforced those regulations put in place by Congress really well. So the CFPB has been working alongside our legislative bodies to improve the financial system for the U.S. consumer.
So generally speaking, do you think that more regulation is harmful or more helpful?
Great question. I suppose it depends what perspective you're looking at it from, right? Big banks, big financial institutions are always in favor of less regulations, right? It makes it easier for them to do business, puts up less red tape, and it just makes business easier, facilitates ease of business in the country, right? So whether that's domestic business, international business, it makes it a lot easier, cheaper, faster for these large companies to enter into transactions, to execute transactions, and to exit transactions. So overall, deregulation, it can speed up the economy, and what I mean by that is increase the velocity of money, right? The number of transactions that are taking place, how many times that money sort of turns over in the economy. It does increase that velocity of money. That being said, deregulation also has some downsides as well, right? An environment of deregulation is what is thought to have caused the Great Financial Crisis that occurred back in 2008, right? The government wasn't paying enough close attention to or what type of borrowers banks were lending out money to. There wasn't enough regulation in place to sort of regulate exactly who was getting money and who was not receiving money. Right, that ability to repay rule that came into place when Dodd-Frank was passed after the GFC really is what sort of revolutionized and changed the mortgage market from one where, was not a lot of verification on a borrower's financial stability and their actual ability to pay that mortgage payment on a monthly basis. In general, is deregulation good or bad? It really just depends which side of the aisle you sit on.
Maybe both.
Yeah, exactly. There are pros and cons. There are pros and cons, certainly.
Following that question, not only how will it affect the market, but how do you think any lending regulations will change?
I don't see lending regulations changing anytime soon. For the most part, throughout history, lending regulations change at a sort of glacial pace, very, very slowly as the economy sort of grows and changes, and then the consumer grows and changes as well. It is likely that we will start seeing some small changes in regulations, especially as it relates to sort of that red tape that I was talking about earlier, ease of doing business. We might see sort of fees increase. That'll be, in my opinion, the first place that we start to see changes are in fees. Right? Financial institutions are going to be able to charge more fees. There will be less regulation, less enforcement of legislation that's currently in place, less additional regulation coming down the line from Congress. So I think the very first thing that we'll see, sort of the indicator that the environment has changed, is going to be in those fees that are incurred by consumers. Right? You'll start to see your overdraft fees, your account fees, your transfer fee, whatever type of fee that we're talking about. That is where we're initially going to see the increase, and the burden on the consumer is the additional fees that can be charged to them by their financial institutions that they're interacting with just on a day-to-day basis.
Thank you, Jared. And do you think lenders and brokers will self-regulate to maintain industry standards?
Absolutely. To an extent, markets always self-regulate. There always sort of comes out an equilibrium or a market standard that's put in place by the largest players who participate in a market. So you're talking about mortgage lending, right? You're talking about big names like UWM, Rocket, and then of course A&D Mortgage as well, right? So sort of what is the new paradigm that emerges from a market environment where the CFPB no longer exists, right? Mortgage companies, mortgage lenders will self-regulate. They will maintain the standards that were put in place by the CFPB, right, prior to its sort of semi-dissolution as it is in its current state, right, with the Department of Government Efficiency, Elon, and the current administration sort of shuttering the headquarters of the CFPB in the last couple of weeks, and telling employees to go remote, but not really to work while they're remote. We'll still continue to see financial institutions following those regulations for now, right? But over time, as sort of the regulatory environment changes, I think we'll see financial institutions adapt to the new paradigm, the new normal, and really sort of hone in on which regulations that were put in place are still being enforced and which ones are no longer being enforced as heavily. And like I said, I really do believe that one of the places that we'll see those regulations enforced less heavily is going to be in those fees, whether it's transaction fees, account maintenance fees, overdraft fees. That, I think, is going to be where we see the very first give and deviation from the CFPB regulations, whether that's mortgage underwriting fees or whatever that may be. I think those fees are where we're going to initially see the quote-unquote give from a pre versus post CFPB market environment.
Interesting. And you mentioned, the mortgage industry is moving, or has always moved, at kind of that glacial speed or slowness. Do you see that this could affect mortgage rates in any way?
I don't know that the dissolution of the CFPB will significantly impact mortgage rates. That being said, there is also discussion about privatizing Fannie and Freddie. Privatization of the GSEs would be very interesting, and that's where I think we could definitely see mortgage rate increases, right? That really has more to do with risk than anything. If Fannie and Freddie were to be privatized, right, and that government interest were to be divested, let's say, maybe partially, maybe entirely, but the government were to have less of a stake in the government, the Fannie and Freddie, the GSEs, I believe, my perception would be, and I believe the market's perception would be, that is an increase in risk, right? The federal government is stepping away from these GSEs, and right, without that backing by the Treasury Department, by the government, they're going to demand a higher interest rate, a higher return on their investment in those Fannie and Freddie bonds. So that, I believe, will certainly push up mortgage interest rates. As far as the CFPB goes, hard to tell at this point in time. You know, a lot of their legislation wasn't really regulating mortgage interest rates. What can you charge? You know, how is risk evaluated, right? That's all coming from Fannie and Freddie. The CFPB is more regulating, you know, interacting with the consumer. And I think first where we're going to see it are in those sort of overdraft fees, account maintenance fees, not so much on the mortgage side, but more on sort of the banking, you know, private banking, commercial banking side with those checking savings account. That's, I think, where we're first going to start to see some change, and then, you know, it'll flow into the mortgage market over time. Will litigation decrease against financial institutions? Will fees actually increase, or will they stay the exact same? You know, maybe there won't be any increase in fees charged to consumers. You know, a lot of data is going to come out of this sort of experiment that we're in right now that will be very helpful for economists and analysts like myself to sort of determine what works, what doesn't work, you know, what should we be keeping, and maybe what is potentially ripe for change.
How do you think we, A&D Mortgage, ensures fair lending?
Oh, that's a fantastic question, and one that's, you know, really near and dear to my heart. So it's really simple and it's really straightforward, right? When we are receiving a file from a borrower, right? When A&D Mortgage receives a submission, we are evaluating your financial situation, and that's it, right? We're not looking race, color, creed, age, none of that stuff is relevant in terms of mortgage lending. So at the end of the day, we are looking for your financial situation, right? What does your income look like? What are your debts? How much cash do you need to service those debts on a monthly or annual basis? And do you have the ability to repay if you were to take out additional debt, right? And that ability to repay, that's a key term coming from Dodd-Frank out of the GFC. That's really what we're looking at. All of that extra information that I mentioned previously, nothing to do with lending, nothing to do with financing, right? We don't need any of that information. We're not asking for any of that information when you submit your mortgage application, right? And it's not being taken into consideration. Obviously, certain things we are asking for, like age, for example, date of birth, to verify, right, your identity. But that's not being taken into consideration when we're actually determining, is this person a viable borrower, right? There are numbers, right, that describe that borrower's financial situation. There are numbers that describes their financial history. Have they serviced their debts in the past, right? Have they repaid their debts in the past? You don't need to really worry about those more ethical concerns, right? The way that we are able to, you know, maintain ethics is just by looking at those important financial indicators that will determine whether or not borrowers have the ability to repay, and sort of just not, you know, not lending any credence to, not really paying attention to those less important qualitative traits that don't really make any difference in whether or not that borrower is able to repay on their mortgage.
When I see loan apps actually with like a higher birth year, I'm like, oh my gosh, they're young and buying a home. I'm so happy for them. It almost makes me like even happier. Well, same for the older folks too. I don't want to leave them out. And for our final question, Jared, what advice would you give to our partners, to me, to anyone watching, on how to navigate these changes, how to remain calm, how to maintain our ethics and our moral compass throughout these changes?
I think that the easiest way is, right, just keep calm and carry on, right? Is it a relatively drastic change to sort of shutter this you know, enforcement agency? Yes, you know, it is a relatively rapid change for that to occur. You don't typically see that happening very often in the United States. That being said, none of the actual legislation that's been passed due to the CFPB, right, pushing Congress to move in a certain direction has actually been reversed at this point in time, right? So all the legislation that's in place remains in place. All of the market participants need to continue following that legislation, right? So if you're changing your business practices because the CFPB no longer exists, you might want to consult with your attorney, right? You could be running into some issues there. So I think, right, for right now, it's just keep calm, carry on. No significant changes are occurring at this point in time. Sort of wait and see what legislation is passed by Congress that would actually affect and change, right, cause change in the mortgage market and in the financial services market as a whole. Certainly no cause for panic or alarm at this point in time. I think financial analysts, economists, or pundits alike are all sort of in a wait and see kind of stance at this point in time. Get an idea of what new legislation will be passed, or potentially old legislation repealed that will actually affect the financial services and the mortgage finance market. So it'll be, like I said, it'll be very interesting to see.
Yes, definitely. And thank you so much for your advice, for your insights, Jared. Truly appreciate it.
My pleasure, Serena. Thank you very much for having me. It's been wonderful speaking with you.
Anytime. Thank you for tuning in to this week's Digest. We truly appreciate it. Be sure to leave your feedback in the comment section about maybe what you want to see for next week's topic, or what you think about the CFPB shutdown. We're happy to have you here. We can't wait to see you next week. Please remember to subscribe, like, and comment on this video. Bye.